Greetings, Dr. Jeffrey Scott here. This is part two of my weekend market update. As I mentioned in the regular video, I was going to do a brief discussion about the Hindenburg Omen and how I use it and why it may be concerning right now. As with part one, this is about climbing a wall of worry. And the question I have here is, does the Hindenburg Omen suggest the markets are going to crash? I am doing this on the 10th, but I always put the Sunday of the weekend to keep things straight. My email address is hgsidoc@gmail.com, and I will respond to any questions or comments. This is for education purposes only. I'm a doctor, not a broker. I'm independent. I pay for the tools that I use. Trading involves risk, and you alone are solely responsible for any decisions you make. If you like my videos, I also would suggest you take a look at stocksanddocs.com, where I will talk about the markets and a couple of things I'm looking at. Typically, I do this quickly in about 5 to 10 minutes, a little bit longer on the Monday morning one. As I mentioned in the prior video, we are hoping to get some confirmations, or at least intent to attend, so we know how big of a room to book. But we'll have our annual Orange County event with Greg Mills, David Larson, and others. Meet and greet on June 6th. The meeting will be starting on Friday, June 7th through noon on Sunday the 9th. Typically, the cost is $300 to $500, typically to the lower part of the range. All depends on how many people are committed to attending. It's a pretty low frills, high value education meeting. If you're interested, please let Greg Mills know at gam72054@aol.com. So I mentioned in some of my rambling in part one that I am my family's risk manager, and that it's my job not just to bring home the money and to make it grow by being in the markets, but to avoid catastrophes. And imagine if you'd retired in 2006. In 2007, you were all in on the stock market. You would have felt pretty bad at the end of 2008 and early 2009. And the human response would have been to take everything out of the market and put it into the bank and earn your 1 or 2% rate, because you had no tolerance for risk. And if you've been a student of the market and in the market as long as I have, you know you would have missed a rip-roaring bull market where you would have made back what you lost and a whole lot more. Ian Woodward is, before he passed on, he gave me permission to use his slides. And I always like to remember his teachings and to call him out because he was such a wonderful person. I wish I could do his British accent, but when you see this little diamond with the 3 triangles in it, this means I got this from Ian Woodward. Now, I grew up in the USA. He grew up in England. We played chutes and ladders. I guess they're less politically correct. And in England, they played snakes and ladders. They didn't care about scaring the kids. And in the game, chutes and ladders or snakes and ladders, you roll the dice and you move up and down this board. The goal is to get to 100, and you get really excited when you hit something like 28 because you immediately run all the way up to 84 and you're thinking, I'm going to win. This is, you had all your stock in NVIDIA and SMCI in 2023 and you're still holding it. So you're almost to the holy grail of retirement, even if you're 30. Then you throw a 3, you hit the 87, and we go into a bear market and you come all the way back to where you started. I've done that. Many people have done that. I haven't done it in a long time, but I did it when I first started out, and that's why risk management became so important. It's great to be a good stock picker and understand the markets. It's even better to know how to hold on to your cash in bad ones. And over trading and being positioned wrong can kill your nest egg and certainly impact on one's retirement. I stick with my signals. I have a weekly market timing signal, which I talked about earlier in the videos, and it looks simply at a weekly chart, a 30-period WMA, and a bongo. I put the major ETFs, I could put sectors, I could put stocks, and I know I'm safe to be long as price is above the moving average and my weekly bongo is green. When they are mixed signals, it's chop, and that's a tough time no matter who you follow. And when you're below the moving average and the bond goes red, I want to be out of the market or short, no doubt about it. I use the daily signals on the same charts to fine tune. If we're in a great market and the daily goes to negative, I'll probably lighten up some and be careful. But my main decisions are going to be made based upon that weekly timing model. The question is, can you just sit on this model and not look at other things? And the answer is no. So I take that weekly timing model and I combine it with various breadth indicators. All of these were presented, the current status, during my regular video. I'm going to talk in great length about the Hindenburg Omen. In my last video, I talked about stocks above or below moving averages, AD lines, and new high, new lows. So I'm going to talk on the Hindenburg, and I'm going to have one comment about the Bango. It's interesting. This was one of the last indicators that I was taught by Ian. And until you have a market that's getting pretty exuberant, you're never going to see it. We're seeing a lot of it. Now, what is that Bango? The Bango, again, introduced by Ian Woodward. To me, it signals a top with, or it signals we're getting close to a top with irrational exuberance as market participants are buying everything. Think about the day that the market's down 500 points. And we sometimes use a comment. They're selling the babies, throwing the babies out with the bathwater. Well, the Bango is the opposite, where the bingo, which is the baby out with the bathwater signal, might signify we're near a bottom. The Bango signifies we're near a top. I use this together with other signals, especially the Hindenburg. If you're wondering what the formula are, you can use it on any index, and it looks at RSI, percent B, and accumulation distribution. When all three of those are positive, you will fire the Bango signal. The Hindenburg Omen. The Hindenburg Omen is an old signal. Ian didn't invent it. Ian certainly made it popular. I know he put some things out on Twitter and he was getting an amazing number of people following him after that. The Hindenburg Omen is a strong warning signal for a market top. I often say it's us amateurs that are buying and the pros are selling. So it's not, oh my God, horrible market, horrible market. It's the opposite. It's an exuberant market. And people that look like me, people who have day jobs that are in the markets so they can grow their nest egg more than a bank account, are really bullish. And the pros are not so bullish, and the pros are selling to us. What's the claim to fame of the Hindenburg Omen? There's never been a significant stock market decline in history that was not preceded by a confirmed Hindenburg Omen. However, 75% of the signals are mainly small corrections. Now, there are some other problems with the Hindenburg Omen today. What index should we use it on? Well, the NYSE is probably the oldest of the current indexes, and that's the one that has been most often used in conjunction with the NYSE, with the Hindenburg Omen. But today we have a market that's dominated by technology, software, AI. Those are not typically the stocks that are within the NYSE. They're in the NASDAQ. Then if you look at the NYSE, it's filled with a lot of weird things, preferred shares, bond funds, closed closed-end funds. I'm not sure that that typically represents what I do. So I typically use the common stocks only in the NYSE. And after the last couple of years of studying, I will also look at the NASDAQ. And therefore you can see why on that Bango and HGSI, a wonderful tool, just like Wealth Charts is a wonderful tool, that in HGSI I can pick which of the indexes I want to use for calculation. The other issue is there's so many variables, you don't always get congruency, meaning I don't always see it firing the same day on different platforms. So I look at the preponderance of platforms. Are they all selling at the same time? Why? Because some of them may be looking at the full NYSE. And if I look at the all NYSE versus the all common, it's different. And I may be the only person that will talk about looking at the NASDAQ, and hopefully I'll show you some evidence that may make you think, why not? So here's the math. Strong warning signal for market top. Here is the traditional definition. The daily number of NYSE new 52-week highs and the daily number of 52-week lows must be greater than 2.2% of the NYSE volume or issues traded that day. The smaller of these numbers is greater than 79, that the NYSE 10-week moving average is rising, the McClellan oscillator is negative on the same day, and the 52-week highs should not be more than twice the 52-week lows. You can have more than twice the lows or the highs, but the highs should not be twice the lows. This is absolutely mandatory. The other thing that's important to know is a single Hindenburg signal should be considered spurious and not acted upon. You need a confirmed Hindenburg Omen, which is a second or more signal triggering during a 36-day period from the first signal. When presented to me the first time by Ian in 2005, he showed the results of all the confirmed Hindenburg signals since 1986. As you could see, there are a number of signals that occur, but if you look at the subsequent decline, and they use the Dow Jones as their example, you could see that only 6 of them had significant corrections of 20%, 15%, or more. A couple, 34.2 in 2000, 38.2 in 87, were substantial corrections. Now, as a risk manager, I want to avoid those. So what happened after 2005? And I like to tell stories, so I'm actually in India in 2007. And it was a place called Udaipur, a hotel's called the Udi Villas. And if you've never been to India, it is an amazing place to visit. It's you think about the poverty that we see on TV, and they have plenty of it. And the other thing they have plenty of is smog. But the opulence of their hotels and their buildings is amazing. So I'm sitting in my room, and I look at the NYSE, and this is at HGSI, and I'm starting to see all these red lines come in. Now, I'd heard Ian talk about this. I knew all about the chutes and ladders. I said, I've got a lot of profits in here. I don't feel like the market's going to correct, so I'm just going to hold on. And lo and behold, the market dropped 11%. That was actually really good for me. And the reason that was good for me is because I was prepared the next time. This was actually '06. It was 14% in '07 when I was in India. '06 was earlier. '07 was 14%. I did not get out. And then this is what happened, and this is why I said '07 was good to me. Because we recovered very quickly and got back to new highs. And then look what happened in the back half of 2007. That's not one spurious signal. That's one that even my 2-year-old granddaughter could say is different than the surrounding area immediately before and after. This was the mother of all signals, and that got me out of the market, at least on the money that I managed, prior to the 2007 and 2008 financial crisis in the U.S. Well, you only get these at a top. And after 2008, 2009, it took us a long time to get to a top. But this was 2018, and you could see as we got exuberance here in February, the Hindis fired and we pulled back into the moving average. This one maybe is a spurious, but we still pulled back. And then here we had another series, and I think 18 was the year that we had the pretty significant pullback and a recovery on the day after Christmas. So the more things change, the more they stay the same, and the Hindi was still working in 2018. In 2019, in August, we had a pretty big market crash. Now, one problem in August was it didn't fire until it started falling, so you didn't get a whole lot of hints. But had you seen the confirmed signal on this bar, you could have still avoided a lot of damage. So this thing, it doesn't fire often, but when it fires, it's meaningful. Well, 2020, and this is where I started to wonder about, is the NYSE the right or the only index that I should be using to look for evidence of the Hindenburg Omen? So here's the NYSE. Now, unfortunately, Wealth Charts and TradeStation, for that matter, and others have dropped the NYSE from the perspective of a market index. So I'm using the S&P 1500 as my NYSE common from the chart. But the internals are from the NYSE. And what we could see, and I'm using EdgeRater to calculate, you can see January 27th and February 3rd of 2020, we fired the Hindenburgs. So here's your two Hindis firing. You are about a month before the market rolls over. But that should have given you an indication that there was risk in the market. But again, it's only two signals. I'm disappointed. So I said, let's look at the NASDAQ. Well, the NASDAQ went crazy. It started firing in January. 7, 8 times confirmed Hindenburg omens between January 24th and February 24th. And I think if you had seen these signals on your charts, you would have at least paid attention to what was coming. So what about the year end of 2021? So I'm again using EdgeRater. You could see that on the NASDAQ, oops, I got the NASDAQ on both. Let me freeze this and let me fix it. Well, apparently with the tool I'm using, I can't copy the snapshot in. So you could see in the NASDAQ a bunch of signals happening in the beginning, at the end of 2021, and then again in early 2022. And notice in red the number of new lows, 22%, 14%, 37%. Even up here, 14%, 13%. So at the minimum, I think this would have made you pay attention. Now I can, if you give me a second, I'll bring up what the NYSE actually looked like. Let me just do this. Move this out of the way so I can see it. So at the same time, the NYSE here fired in November and again in December. So between the two, you had a bunch of Hindis firing. So here is a chart from 2022 of the NASDAQ. And now this is actually a weekly chart. But I looked at when did you see signals firing. So here's the market going into the end of 21. Here is the market top, no question about it. And here you see the week of the 18th, you saw 1. The week of the 15th, you saw 4. The week of the 22nd, 1. The week of the 6th, 2. The week of the 10th, 1. So between November 10th and January 14th, we had 9 Hindi omens fire. Now, if you had plotted that on your chart and you knew what I showed you this afternoon, would you not have believed that the Hindenburg Omen was an important signal? I think it is. And I know it's an old wives' tale. And I know part of the problem is you got to know what to study. You got to know what to run the test on. And I think the markets have changed and you need the NASDAQ. So let's talk about what's going on right now. If you look at the NASDAQ on the left, the NYSE on the right, calculating this on the EdgeRater, and you can see EdgeRater has each of the criteria that are necessary to trigger. You'll see that on the NASDAQ, starting in the middle of January, and now we've had 8 confirmed Hindenburg omens fire in less than or about, less than because it's the 10th, a month. And on the NYSE, we've had confirmed Hindenburg Omen sign, one on the 16th and one on the 5th. So you got to take a look at the totality of evidence. We know from everybody on YouTube and everywhere else that the moving averages, the AD lines have not kept up with the indices. So you have massive divergence. We know that the stocks above the 50 and the 200 day have not kept up the percentages with the moving averages, creating significant divergences. Everybody knows that. Earlier today on my video, I showed that the AD lines are fine on the NASDAQ 100 and the Russell 1000, but there's clear divergence between the AD lines on the broad and the index on the broader NASDAQ composite and the Russell 2000. Add this into that piece, and then we bring you into where we are in a new tool again. This is from Sigar Nandi. He is a brilliant engineer who developed his own software tools. I've been friends with him since I bought him well over 10 years ago. And after talking about Hindenburg Omens and bingos and bangos and bongos, he's built them into the program. And this is a composite that includes the NASDAQ and the NYSE. So maybe the best way of dealing with this is to just combine them together. Let's take a little journey. The blue arrow up occurring in the beginning of 2023 is a bango. As I taught you a few moments ago, the bango is a sign of irrational exuberance. We only had one fire and the markets fell. Notice these, I don't know, is that magenta? Magenta arrows pointing down. Those are the bongos, the bingos, the baby out with the bathwater signal. So the bango shows a high, the bingos show a low. We run up. We had some bangos, not much happened. More bangos, not much, just a little pause. And then we got into July of 2023. We had a number of bangos firing, showing the exuberance, and then the skull and crossbones. That is the sign of the first Hindi. The pink one that followed here showed a confirmed Hindi. And what did the market do? It sold off. You had more Hindis again in September, followed by the bingos. The market rallied, and then the market further sold off with more bingos. Well, where are we today? We've had a massive rally in the markets. We know that the S&P 500 has now broken 5,000. It is at all-time highs. The NASDAQ Qs, the NASDAQ 100, all-time highs. The NASDAQ Composite, not so much. The Russell, nowhere close. The diamonds hit all-time highs but have backed off a bit. So what are we seeing today? We are seeing, after a pronounced run-up, bangos at the top with confirmed Hindenburg Omens. To me, that's enough to make me nervous. I'm not ready to go short because I don't go short on these signals, but it does tell me to pay attention. If I look at the NYSE on the right and the NASDAQ on the left, you could see on the NASDAQ, here's your Hindenburg Omens, confirmed, and a bango occurred on Friday. On the NYSE, here is your initial Hindenburg, and here's the one that confirmed it. This is at the time when we're at all-time highs or approaching all-time highs. This up here are the stocks in yellow above the 50 and white above the 200. Notice how they've come down while the indices have gone higher, and that's an example of the divergence. So, what do I do with this information? It does not necessarily signify a top, but it should make me aware a top could be near. So I've already eliminated, but when I start to see these signals, I reduce or eliminate my margin exposure. You want to lose money? Be heavily margined when the market rolls over. It is not fun. I'm going to tighten my stops. I already have. And then I'm going to take profits so I can re-enter at lower prices if and when these signals play out. I do not see this as a signal to go short. You need to see the indices to react. You need to see the indices roll over to react, I should say. So on that note, I want to thank you, anybody that actually stuck through this. I hope I've demonstrated to you that although the Hindenburg Omen is an old wives' tale in many people's mind, and Myrna Fossback, may she rest in peace, was a friend of mine, recently passed. Her husband, Norman Fossback, I think he invented the new high, new low logic indicator. The Hindenburg was based upon his work, and I know he wasn't a fan of the Hindenburg. Personally, I'm a fan of anything that gives me an edge of what the market is doing. And to me, I got that edge from the Hindenburg. And perhaps we should be looking beyond the NYSE. And that's why I've started looking at the NASDAQ. Have an awesome, awesome week in the market. And I look forward to seeing you next week on YouTube and during the week on stocksanddocs.com.